for the future. It will cover contents from Bodhi's book, chapter 10 and 11, and also some other content I find relevant based on my understanding of fixed income. Okay, so we're gonna have two parts in Unit 4. The first part will be introducing bonds in general and interest rates, all those really fun stuff. The second part will be using fixed income to hedge liability. What are the ways? What do we need to think about? And then that's when we introduce duration, convexity, and some related concepts. Okay. So let's talk about bond pricing basics. So this is a bond. Okay. So first. So this is a 8% coupon bond. Okay, so that's why this is the par value. Okay. In this class, the par value is going to be defined as 1,000, just like you guys learned from Finance 680. It's taken from me. However, you need to know that sometimes, okay, some other people, okay, they will define the par value as 100, or sometimes just 100%. Okay, so just keep this in mind. Okay, and this shows the bond price on a different in market interest rate. Okay, 2%, 4%, 6%, 8%, 10%. Okay, it becomes necessary to use Excel for you to understand what's going on. So let's shift to Excel. Okay. So the main reason why you need to use Excel is something called a timeline. Okay. So in finance, it's all about time and cash flow. Okay. So we can just look at the first one. You should be able to download the slides, okay, slides online in Blackboard. So I will just focus on Excel right now. Okay, so let's look at the first one, 1 year bond. Okay. So we assume it's a 0 coupon. I think that no, it's 8% coupon. Sorry, that's why it should be 8%. Okay, so we assume it's annual coupon. So okay. So that's why for 1 year, at the end of the year, okay, you will receive 8% plus 1, then times 1,000. Okay, so this is your this will be your end of year cash flow. Okay, so that's a future price, right? We always want to calculate the present value. Present value of this, if we assume 8% interest rate, present value can just do 2%, okay, 4%, 6%, 8%, 10%. So what is the present value of this? Okay, that will be your future value divided by 1 plus this. Okay, and then it's only 1 year. Okay, so is that clear? You guys understand this? This Excel, it's pretty straightforward. Okay, you guys should know this from a long time ago. Okay, and then we can just copy those here. So that's what we have here in the first line. Okay. It's a little bit different. Do you guys know why it is different? Can anyone of you tell me why it is different? So it's different probably because they didn't do annual compounding. Okay? They probably do semi-annual. Okay? Cash flow. Oh, I think this is probably wrong. 8% plus 1. This is okay. I think that's probably this is what's going on. Okay, they did semi-annual compounding. Okay, so if you do this, divide by 1 plus rate to the power of yes. Okay, then you can just put this, add those two together. So this is what's going on. Okay, it's close enough. Okay, maybe they didn't even do semi-annual. Maybe they did it continuous. Anyway, the whole idea is the same. Okay, we did a semi-annual compounding here, and then right here there are multiple ways to do it. Okay, you can do this to the power of 0.5, or you can simply do this divided by 2. I wouldn't say which way is better. We see I still cannot get the results they have. But it doesn't matter. Okay, we will just stay with the results we have here, and then you should consider this to be accurate. I was in the textbook probably needs to explain this better because the results they have is a little bit different. Okay, so this is 1 year. Okay, let's just do semi-annual compounding. This is pretty straightforward, right? And then you can see the present value. This will be the price. This will be the interest rate. And then we can just plot those two. Okay, insert. Just plot those two to get the price of a bond, the relationship between the price of the bond and then interest rate. Okay, so that's what they do here. Okay, they have some curvature because we only did a 1 year bond. For a 1 year bond, the curvature would be less compared with long-term bonds. Are we good understanding this? Okay. So again, right here, okay, the long-term bonds, okay, long-term bonds, okay, we have more curvature, okay. So we will talk more about it. We plotted a 1 year bond, right? 1 year bond. And it's pretty much like a straight line because it's only 1 year. The time to maturity is very short. It's pretty much less sensitive to a factor we're going to introduce later. Okay. So what we illustrated a while ago is called a price risk. Okay. So what is a price risk? The price will fall as market interest rates rise. Okay. So this is price risk. So the relationship between price and the interest rate would be called price risk. Okay. So that's why when you buy a bond, you wouldn't think it's safe. Okay. You will just you need to consider all those risks. Interest rate fluctuation are primary source of bond market risk. Okay. Bonds with longer maturity are more sensitive to fluctuation in interest rate risk. We will talk about this later. Okay. More details later. I'm trying to write with something I just bought online. I think it's very interesting. I will try to see how that goes. We're going to talk about another important concept called reinvestment risk. Okay. So what is reinvestment risk? So you need to know in finance, okay, the timeline is very important. Okay. So that's what we have here, the timeline. Okay. So this is a bond that pays you $100, right? $100 here. What does that mean? It means the coupon rate, okay, is 10%, okay. So that's what it means. Okay, coupon rate is 10%, and then the par value is 1,000. That's why every year it will pay you $100 coupon. Okay. When you receive $100 coupon, this is $100 cash, right? You need to invest. However, the interest rate will change differently. Okay, you don't know what the current interest rate environment is. So right here, if you can get a 10%, basically use $100 to buy another bond, 1-year bond. Okay, if they can give you 10%, okay, you are going to make 110 at the end of the year or year 2, right? And then this is a 2-year bond. Okay, this is a 2-year 10% annual bond. Okay. At the end of year 2, okay, they are going to give you the principal plus $100 coupon. Okay, so you will have $1,100 plus the reinvestment return. So in total, you will have $1,210. Okay, so what is your return? Again, you bought it at the par, right? 1 plus R. You invest for 2 years. Okay. So this is how much money you have 2 years later. Okay, you can calculate R. This would be equal to 10%. Okay. Is that making sense? Okay. So and then another scenario is if you receive $100. Okay, 1 year later. However, the interest rate environment is not that favorable. Okay, you get only 8%. So with your $100, you can get only 8%. That's why you have 108. And then you have this. Okay, this is less than 1210, right? So that's why your R here will be less than 10%. Okay. So this is reinvestment risk. Okay. It's a little bit hot here. Let me turn on the air conditioner. I'll be right back. I think my computer is overheating for some reason because of the graphic card I have. Are we good about reinvestment risk? Okay, this is going to be a very important concept. You will be tested. Okay, you need to know the R I calculated here. Okay, this is called realized return. Okay. This is a realized return. It's very different. This is the concept we're gonna have here. Okay, this is going to be an important concept. Okay. Realized compound return, because historically you expose yourself to yield to maturity. What is yield to maturity? You know the price you are paying for. Okay, and then you simply calculate the internal rate of return. Okay, like. So you have cash flow function, right? Cash flow function from the calculator. And then you know it's $100, right? Divided by 1 plus R plus 1110, 1 plus R squared. And then it's equal to the price you pay. The R you calculated is called IRR. If you don't consider cash flow reinvestment, this also equals to something called a yield to maturity. Okay. Your yield to maturity can be very different from your realized return. Okay, realized compound return can be different because of reinvestment risk. Okay. So this is a really important concept. Okay, yield to maturity. This will equal to this if your yield to maturity, okay, equals to your reinvestment rate. Then your yield to maturity will equal to your realized compound return. Okay. In reality, it's not the case because interest rate changes every day. You cannot guarantee that your reinvestment rate will equal to the rate you initially get. Okay, the yield to maturity is the current rate, okay, current prevailing rate. So this is also important. All coupons, okay, are reinvested at the rate of yield to maturity. Okay. The next slide talk about options. Okay, we did talk about call, right, and put options for stocks. Okay. However, those options for stocks, yes, they are heavily traded. Okay. However, for a financial institution, something more common would be bonds. Okay. They do issue bonds with call options. Okay, so this is an example. Okay, so this is a straight line. Okay, no, this is called a straight bond. This is previous price, and then interest rate, right? Price interest rate relationship. It's a curve. Okay, so when interest rate goes up, okay, the bond price will decline. When interest rate goes down, the price of the bond will increase. Okay. So ideally, you want this part, right? This is good for you. If you long a bond, and then when interest rate goes down, okay, you will make more money. Okay. However, companies will think when interest rate goes down, right? Like if they issue a bond with 8% coupon, like in 2017, okay, and then right now it seems the prevailing interest is around 3%, okay, for corporate bond. This is not a good deal for them anymore. Okay, so this is a bad deal, especially if they issue a 10-year bond, right? At 8%. They probably want to do some changes. Okay, so what can they do is they can say, I can call back. They will always say how much they will call back for. Okay. Let me just erase this part. They will just say, they will tell you, okay, they will tell you that maybe 2 years later, you can callable at, like, this is 110% of par. So this is a contract. Okay, when you buy the bond, you have a contract with a company. Okay, and then the company says 2 years later, okay, they have some lockup periods. That's very common. 2 years later, okay, they can pay you 100% of the par, which is $1,100, and then you have to. Okay, this is a right they have. This is a right company. Yeah. Company has. Okay, you have to sell. You have to sell back if they call. Okay. So this is really important. Okay. A lot of times when you deal with valuations in bond, most of them will have options. Okay, so it's not like going to be what you learned in Finance 680 is very fundamental. It's very basic. A lot of bonds will have options embedded. So you need to know that when interest rate decline, right here, if they can call it at 1100, they will always call it. As soon as the straight bond price is above this, they will call it, because everyone knows. Okay, because everyone knows they can call. You guys see it? So the curve, like when the interest rate is very high, okay, those two curves kind of align together with each other because they don't have almost zero, right? Almost zero risk of call. However, when interest rate begins to decline, okay, the risk of call kind of step into the pricing of the bond. That's why callable bond will be always priced cheaper compared with a bond with no call options. And then when it is close enough to the par value, right here, you will only approach the par value. Okay, you will never be above it because everyone knows the company will call it. It's just free money to them if they call. So that's why companies will always call it. So really important concept. Okay, you need to know that when you buy a callable bond, okay, you essentially is right, or you essentially short call option. Okay. So this is what callable bond means. Okay. So if you took class with me, okay, I think the second part of the class you will probably need to use Bloomberg, so that's why we're gonna try to meet in classroom. When you look at bond, when you look at companies' bond, right, many of them are callable bond. What does that really mean? It means essentially you are writing them a call option on the bond. Okay, you will be paid a little bit more. However, you do take some risk. Okay. And then we have put option too. Okay. So what is a put option? So this is your right. Okay, this is your right. Sorry. Yeah, there's eraser here. I always hit on it. Okay, this is your right. This is your right to sell back the bond. Okay. So this is good for you. Okay, this is good for you. Look, when interest rate goes up, right? When interest rate goes up, you lose money, right? You lose money. However, what the call option, what the put option says is, you can sell them back. Okay, you can sell the bond back to the company. Okay, let's say maybe you can sell it back at like 85% of par. They will have that. Okay, so this is a protection for you. You are going to lose less money. Okay. Is that making sense? So this solid line is option-free bond. As you saw a while ago, this is also called a straight bond. Okay. And then if you have options, put options, okay, right here, you will follow this dashed line. When the interest rate goes up, you will not lose too much money because you have a put option available. Okay. So when you buy, essentially you long, okay, you long put option together with a straight bond. Okay. So this is what a puttable bond is. Okay. So when we say you long an option, you have to pay for it, right? You have to pay for the options. Okay. So this is when it's more expensive. Okay. But some people buy it because they think interest rate will go up, or they just simply think this option is right now fairly cheap. Okay. Let me erase this. I think I will add another point. Okay. So again, we are moving in the territory of institutional traders. Okay, so some concepts might be a little bit complicated, or you don't really see them, right? It's not like the first part of the class when I ask you guys to do an investment policy statement. Even you have no idea what's going on, you can still make it up. But right now, if you don't understand the terminology, it'll be really hard for you to follow, okay, or even understand what they are trying to do. So another reason why they would buy a puttable bond, again, it would be two things together, right? It's a straight bond plus put option. Okay. Institutional investors are a little bit different. Okay, very rarely they're gonna have two things stacked together. In their opinion or in their word, okay, those two shouldn't be mixed. Maybe if they have a puttable bond, maybe they are just interested in the put option. Okay, they have a long position here, right? Maybe they think the put option on this bond or in those bond portfolio is very cheap. They think it's probably underpriced. Okay, probably underpriced. That's why they have a long position here. And then after they bought a puttable bond, they will probably have a short position. They will short a bond, right? So that those two will cancel each other, right? And then this is underpriced, and then they can also sell sell another put option on the market, okay? Because that's where they think they can add value. Because the product is very complicated, and then bonds with options, they are not that liquid. So maybe the put option here is underpriced, okay? They will probably sell a put option on exchange that is relatively liquid, and then long a put option within a puttable bond, so that they can make some profit here. Okay, it's very common. I can see that some people will try to trade this way in their institutions. Okay, but I don't recommend individuals to try it because it's a little bit illiquid. Okay. Everything we are doing here, okay, they need to trade in millions, okay, maybe 10 million, 100 million at a time, because you guys can try, okay. You have the Investopedia stock simulation, and you can try to buy a bond to see what it looks like, okay. You will have very high bid ask spread, okay. So even if you make some money, a lot of money will go to the dealers, okay. You're probably not gonna make that much money after you consider the trade and transaction cost. So just emphasize again what we covered so far. Okay, you need to know that bonds with options is a really important concept. Okay, callable bonds would be the value. How do we value them? Right. For some exams, they will focus on valuation. For this class, I'm not going to focus on valuation, but I will still feel obligated to share with you what I think is important when it comes to valuation. Okay, it's the value of a straight bond minus value of a call optional bond. Okay, because you short, right here you short or you sell a call, and then for put bond, right, it's value of straight bond plus value of put option, because right here you long, okay, or you buy a put, so you need to pay for it. Okay. We also have something called a convertible bond. What is a convertible bond? So you buy some bond that has provision that you can convert bonds to stocks, right, at a certain price. So this is what convertible bond is. Okay. Do a lot of people buy it? Yes, a lot of financial institutions, they buy convertible bonds because it gives them a lot of flexibility. Okay, if they want to have, let's say, if you have a company you are interested to buy, right? However, you are not quite sure what it looks like in the future, so you can just buy a convertible bond because most of the time it will be just like a bond. Okay. Even if the company is doing really bad, okay, we all know, right, it has different layers, right, debt, holder, and then equity, right. If you don't convert it to stock, you still have a superior claim, okay, on the assets, so it's fairly safe. So that's why they will try convertible bond. When are they going to convert? They will convert only if the company is doing great. Okay, let's say the current stock price is like 20, and then the company is doing great. 1 year later, it's like 90, right? And then convertible bonds, it's a really easy way. Let's say the convertible price is decided is 80. Okay, so when the stock price is 90, okay, the convertible bond will be priced at 90. Okay. You would just think that way because everyone knows you can convert any time, and then the stock price is really good, so you have some profit. Okay, so when the stock price is above the strike price, they don't really call it strike price. This is called a convertible price. When the stock price is above it, the price of a convertible bond moves very like stock. Okay, so you feel like you get the benefit of both sides, right? That's not necessarily true. You kind of bought a straight bond together with the value of a call option, right? So essentially, you have a bond with you, and then you long a call option, right? You long a call option with a strike price of 80. Okay, so that's what's going on. Is that making sense? Yeah. So if you guys can give me some feedback, that would be good. Otherwise, I don't really know whether you guys are following what I'm saying here or not. Seems I have some issue with this eraser. Okay, so it's getting better. Okay. These are very common. Okay, so that's why I think most of you took class with me in 680. Okay, in 681 we didn't really talk about it. That's why fixed income is hard. Okay. This is one part because it has a lot of options or derivatives attached to it. Okay. That's one of the reasons why. I'm going to tell you a different reason why it is hard, because it's only one layer, it has multiple layers. Okay. Another reason is because credit. Okay, we talk about interest rate, right? Yeah, kind of something we cannot even control. Right? Like you have no idea what would be like tomorrow. Is that today or tomorrow? Yeah, Fed's chairman Powell, okay, is going to talk about the overall economy, and then what they're going to do about the interest rate or monetary policy. You have no idea. Financial institutions, okay, a lot of times they will try to quantify it, but still I don't think they can do much. Okay, however, right here, credit risk is something they do a lot. Okay, last semester, for those who took classes with me, we talked about mortgage-backed securities. I talked to some students after class. It seems you get lost. It's totally okay because this is the main reason why we have the house crisis. You wouldn't blame that I didn't explain well. Certainly, if I explain better, you can understand more. But this is a hard topic. That's why we have house crisis. That's why people lose a lot of money. Okay, if it's very easy to understand, everyone should get it already. Okay, that's a beautiful part of finance. Okay, there are a lot of things we don't know. Even the smartest people don't know. And then we kind of see what happened after the fact, and then try to learn from the history. Okay. So what is credit risk? If you buy a bond, they can default, right? You would say probably not many bonds will default. That's not true. Okay, a lot of bonds will default. Okay, even municipal bond. Okay, we have Detroit, right? They have default, and then in 1998, Russia, right? Russia, other country, default on their bonds. They just say, sorry, I cannot pay you back. Okay, so that's what they say, and it is okay because it's legal. I told you all, finance is just a lot of legal contracts. As soon as it says in their legal contract with you that they can default on a certain condition, and then they can show you why they cannot pay you back. Yeah, they can default. Okay. I'm not quite familiar with the 1998 Russia default case. Can they pay back in the future because they collect tax from taxpayers? I don't know. I think they could, but I don't know why they default. So you guys, if you do some research, you can probably tell me more about it. And if default is not that common, credit change. Okay, like if we have a A-rated bond, right? It can change to a triple B. Okay, or it can put double B. Okay, it can even go lower, right? This is called credit. Called migration. Okay, this is very common. Okay, I think for Tesla as a company, I'm very sure they have fairly good rating originally, and then right now they are in the junk bond area, okay, or speculative area. Okay, it's a credit shock. You would say that. Okay. Do we manage it? Yes, we do manage it. Okay. You would say, I don't really manage it. When I buy a bond, how can I manage the default risk or credit migration risk? You don't, because those are not really available to individual investors. That's why we don't manage it. But remember, we are talking about institutions here. Okay, everything starting in the second part of the class is all about financial institutions. Okay. They are fairly large. Okay, banks. You can think of Bank of America, right? You can think like that. We will also talk about like Winthrop Foundation, how do we manage that? It's all pensions, right? We do still believe they belong to financial institutions. Like Winthrop Foundation, I saw the investment policy statement you guys did. As a group, you guys did a great job. Okay, we have around like $56 million, right? It is very small. They probably don't have like collateral, right? If you buy something, you cannot require them to post collateral. However, if Bank of America holds some companies' bonds, okay, like credit risk management, if Bank of America buys bonds from Tesla, right? They can require Tesla, okay, to post collateral. Okay, so what is collateral? A lot of times, cash will be considered collateral, right? If you default, I still can recover something. Okay, I can still get something back. Or government security, right? Treasury bills, or even some other security like Tesla. They'll probably not take their factory as a collateral. They could, but the kind of collateral is not ideal. Okay, so let's say Tesla says they have something called a mega factory, right? So it says this is $100 billion. Then can I use this as a collateral to borrow money from you, Bank of America, or can you, if you buy bonds from me, right, as a way to finance it, can you take this as a collateral? Bank of America said, yeah, that's fine. However, I will only value this like 40. Okay, I will consider it to be $40 billion because look, if Tesla default, Bank of America has to find a buyer, okay, of their mega factory, which is very likely like General Motors or Ford, right? They will probably negotiate a lot. It will probably take several years to sell their factory, and then they probably to hire several financial analysts and some attorneys to be involved. So they don't really like it. They will take something called a haircut. Okay? They will consider only maybe 40% of the value. Okay? Another thing in managing credit risk would be netting. Okay, like if we have party A and then party B, right? This financial institution, a lot of them are trading, right? If we have a future contracts here, and then we have a swap contracts here, okay? So if the future contract, right, currently is, I talk about future contracts, let me just go straight to the point, okay? Let's say we all talk about this from the perspective of A. Let's say A makes $10, right? B, 1 year later, need to pay A $10 right now based on the current price movement. However, they have another thing called a swap. Let's say it's an interest rate swap. And then from A's perspective, they lose $8, right? So a long time ago, okay, they would just let those two contracts roll, okay, and then 1 year later, B will pay A $10, and then A will pay B $8. So this will happen in 2000. This will happen in 2008, okay, in Lehman Brothers, okay. Okay, I think it's 1 day before their bankruptcy, a European bank deposited around $100 million into this, okay. So that's what you can consider that as a $10. Okay. However, they owe them more money, but they declare bankruptcy, they didn't give money back, so they lose money. So that's why they have this idea of netting. Okay. So let's say let's do this. Okay. Let's do a daily netting. Okay. So every day they will just look at their position with each other. It seems they have only $2 position for A, right? So they will say, we are clear, okay, we have only $2 position right now, let's just manage. They don't pay it, they don't pay $2 every day, okay, because those are financial institutions. Individually, you will probably pay them $2. They will just consider $2 as the risk or the credit risk. Right here we're talking about credit risk. They will only consider $2 as credit risk, okay. So let me erase this. Are we good about credit risk? Those are all. I mean, I talk a lot about a lot of concepts. The collateral itself, you can find many jobs here. Okay, your job will be just doing collateral evaluation every day. Okay, or you can talk about netting. You can just do that every day. So Patrick had a comment. Okay, so let me just. You guys can see that right from the Skype. He says credit risk jobs within banks have become an integrated part of their operation, so that defaults stay at minimum. Yes, that's quite true. I just want to add a little bit to that, given that you bring that up. Okay, banks. Okay, face mainly several risks: market risk, credit risk, and operational risk. Okay. Banks, they incorporate those three into something called enterprise risk management system. Okay, they manage them all together. I wouldn't say that credit risk is managed within operational risk, because if you work for banks, right, you will have a credit risk department. Okay. And then operational risk. What is operational risk? It's like you have a database, right? You have a database, or you have a server, right? You have some machine, you have some flood, right? All those kind of, or you have like branches, right? Oversee. Those will be considered operation, like daily operations. Okay. Credit risk is credit product, right? Market risk is a lot of times to talk about market risk, like price risk, reinvestment risk, credit risk. We will talk about. We will talk about. Let me just credit risk. Okay. Talk about bonds. Okay. A lot of time, and also if they have loans, right, they will also manage that kind of risk. They do have default. Okay, it's not like default is close to zero. The purpose of credit risk management is the purpose. Okay, the purpose is not to eliminate credit risk. Why? You have to take some risk. Okay, it comes back to the first part of the risk-return trade-off. Okay, you have to have some risk to get some return. You think about banks, right? They have many small loans to small companies. Some of them will declare bankruptcy, and then banks cannot collect all their loans back, for sure. Their purpose is to manage it, right? Manage it, and then will not fall if bad things happen. So let's say the only reason why banks manage credit risk is because if we have some event like 2009, okay, a lot of financial institutions declare bankruptcy, a lot of individuals, right? You have a house and then you cannot pay it. That's also a credit event. Okay, if that happens, the bank will be okay. Okay, so they have enough cash in hand to handle that kind of situation. That's the purpose of credit risk management. Okay. So there are a lot of jobs here, okay, in Charlotte area, credit risk management. And then financial institutions will use centralized exchange to manage credit risk. That's what they found to be more efficient. Okay. So what I'm saying is A and B, right? Even if it's, let's say this is Chase, this is Bank of America, very big, right? They can manage their transactions among each other, but they don't find it to be good. So they'll probably add another party called C. Okay, they specialize in sorting those contracts for those two parties. They have D, right? They have D. C, the central, right? Central position. They kind of act as a centralized exchange. They will act as a buyer, or they will act as a counterparty to each party here. And then A, B, C, D, they are all very big. Okay, maybe this is Chase, this is Bank of America, this is probably TD Ameritrade, right? and then this can be Morgan Stanley. It has banks and also has financial institutions, and also we probably have some hedge funds, right? So they will act this way, okay? So I feel like I would like to write a lot. So let's just go back to the basics. Okay, credit risk is a really big part. For this class, the requirement is kind of very minimal. Okay, you just need to know what I'm talking about so far. We have ratings. A lot of times I go with Standard and Poor's ratings. Okay, AAA. A lot of government fixed income security would be AAA rated. And we have AA rated from some emerging market government security, or some like European market, maybe they have AA ratings. US is always AAA, so you need to be grateful that you have a lot of credit. Will it default? We don't know, right? But at least we think it's AAA. So again, those are provided by them. Okay, those are called a credit agency. They have their methodology. You don't have to agree with them, but they are kind of experts on ratings. A lot of times they make mistakes. They're not super smart. That's why they provide ratings. They don't make a lot of money either. Anyway, and then the high quality will be A and BBB, right? Those will be still considered good. And then we have speculative, and then we have very poor. Then we have unrated. Okay, it's not listed here. It's just empty. Okay. So some company or some fixed income securities are not rated. Okay. So those unrated will be you wouldn't assume it's worse than very poor. Okay. So I think many people would just say unrated is even worse. That's not really true. I think historically they are very kind of aligned with speculative, because you need to find out why they are not rated. Okay. So there's another point. People use ratings to classify a bond into two. One is investment grade bond. Okay. It's speculative. When people talk about junk bond, you need to know that it's rated BB or below. Okay. So this is yield spread. What is that? It's just the yield to maturity of a bond, right? Or bond portfolio minus, right, the yield to maturity of treasury bonds. They have the same duration, by the way. Need to make sure they have the same maturity. So that's why in this case we look at the 10-year. You don't have to look at the 10-year. Okay, you can look at 5-year, 1 year. Doesn't matter. Okay. So this is what it looks like. Okay, so let me erase this so that we can have a better idea of what's going on here. So we can see that the red line is B-rated. Okay. So it's kind of premium. Okay, you can consider this to be the risk premium for B-rated bonds. Okay, U.S. bonds. Okay, you guys can see that you need to pay people more. Okay, so because it's B-rated, this is junk bond. Okay, junk. You need to pay people more. Okay, you need to pay investors more. How much more do you need to pay? Historically, around 10%. Okay. Can you guys see it? Any questions? So let me. I like to draw a lot. I like to write a lot. So 10% is fairly high. Okay. You guys see that? This is really risky. Okay. If you want a high return, we call it junk bond for a reason. Okay. Because it can default. Okay. And then if you look at AAA, right, you want something safe. How much do they pay you? Very low, 1%. During 2009, the financial crisis. Okay, this is 2009. Okay, 2009, 2008. This is a credit event, guys. as I mentioned, right, people stop to pay their houses. People move out of their houses because they cannot afford it. They claim default. It's a credit event. Originally, it was credit event, and then later we have some liquidity issue. Some financial institutions. The only reason why they are in trouble is not because they lose too much money. It is because they don't have enough cash to maintain their daily operations. Okay, so that's why the federal government steps in to bail them out, to provide them short-term cash needs so that they can recover. Okay, so we can see that AAA doesn't really change that much, right? This 2009 AAA, kind of stable, right? Stable. Because credit risk doesn't really impact them. Even if everything goes wrong, AAA rated bonds, what are they? Those are the bonds from US government. Okay, it does not really have large impact. If you look at B rated, okay, investors are just so worried about large scale of bankruptcy here that they require almost 18% return, okay, 18% annual return on a bond in 2009 at one time. In the history, okay, that's very high, okay. Most of the time, B-rated, right, is very close to 10%, which is very common to the 9% historical risk premium of equity, okay. That's why we have, if you take economics, we have a Gini model to predict the current stock price. They use B-rated, okay, B-rated bonds as a proxy for equity premium. Okay, so that's that will not be tested in this class, but it will be good to know if you're interested. This is a point that you kind of get it already from the slide I showed a while ago. Okay, speculative bonds are more sensitive to changes of credit risk. Okay, investment grade bonds are more sensitive to changes of interest rate. Okay, the yield curve. So there are a lot of we talk about the bond spread, right? If you look at this, it's just 10-year bond yield to maturity corporate and then treasury bonds. We have many other spread available. We have something called a swap spread. Sometimes people call this I spread, sorry. So this can be very similar. Why we have this? Because swap rate is available, okay, for all kinds of bonds and all kinds of maturity. It's not like, if you look at this, okay, treasury bonds, this is good, right? However, you don't really know, like, we have 1 year, 2 year, 5 year, 10 year. What about I want to do a 1.5 year? What about I want to do a 3 year? They don't really have that available, so that's why we move to a swap spread. And you just need to be familiar with those, because if you use Bloomberg, you will see those things, okay? You will see more than those, actually. You just need to know what they are. It can be a definition question, okay? And we have TD spread. We talk about LIBOR rate, and it's the difference between treasury bill, and then we have zero spread, okay, Z spread or zero volatility spread. This is really important, okay? Heavily tested as a concept. What is zero volatility means? So I will talk about interest rate. Okay, interest rate is the future. They just assume that interest rate is given. Okay, and then no volatility, volatility. They just think interest rate. We all know, we kind of can guess what the future interest rate will be like, right? You can have many different rates. We will just take the average, and then we assume that will be the interest rate, or they call it spread rate, and then we can calculate something called a Z spread using that. Okay. We have CDS spread. We will talk about it. We have some protection, okay, and we have option adjust spread. Okay. So we talk about bonds with options, right? So those bonds can be called if it's a callable bond, right? Those bonds might be called in the future. that will certainly impact your future cash flow. Okay, how will that impact your return? We are going to use OAS. Okay, this is also important. It's called option adjusted spread. This is a spread that adjusts for the potential payoffs of options in the future. So that's why you cannot do this by hand. You have to use Excel. You have to write a macro in Excel. Okay. I'm not going to teach that. I didn't really use it that often either. Or you can use software, right? They have some software for sale, or you can use Python or R to do it. Whatever you choose. So you can just simulate the future potential payout, then you can calculate option adjusted spread. Are we good? Okay, I think let's take a 10 minutes break. I get some water and we're gonna come back. Okay. And I stop recording.